Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on the hidden cost of waiting and timing your NSOs, which are non-qualified stock options, to maximize tax efficiency. So before we dive in, let's start with what are non-qualified stock options, also known as NSOs. And basically what it is, it's a form of equity compensation that allows employees, directors, consultants to buy shares of a company at a certain price once that option is granted. So we're going to dig in a little bit deeper today and talk a little bit more about stock options and really the tax side of this, because I think that's really important. And so as we take a moment here and we think about stock options, a lot of times, a lot of clients or investors think, well, I'm just really worried about, I want to think about what the price is and is it going to go up and when do I want that stock to go up in value before I exercise. And so on the surface, it may sound like, yes, go ahead and do that. But the reality is there definitely are some tax consequences to consider.
The big decision is not just the stock going up, but how is the gain going to be taxed when I exercise? So you definitely want to know how your non-qualified stock options are taxed, because most people don't really realize what that looks like.
Yeah, you're thinking, I'm getting this stock options. That's great. It's wonderful. I'm getting shares of the company. But the reality is, depending on the stock that you get and the price of the stock, and when you exercise it, it could be taxed at ordinary income. And at that point, it could, depending on your income level, and with these options, it could kind of bump up your tax bracket too.
Yeah, typically these stock options catch people, or any stock options for that matter, catch people off guard because they really don't realize what they're getting and who's paying the tax and where's the money going to come from.
Exactly. So let's break down kind of how non-qualified stock options work. And so basically you're given this option to buy a stock at a fixed price, which is your strike price. And you're not taxed when you're actually granted these options. You actually are taxed when the options are exercised. So once again, let's talk a little bit about what that means, because I know there's a lot of terminology here. So exercising a non-qualified stock option means that you have the right to purchase shares of a company at a predetermined price, which is the strike price, after it's vested. And then that's kind of your contract with the company that you're basically given this opportunity to buy shares. And so you're taxed when you exercise them, which means you're taxed on what's called the spread. And the spread is the difference between the strike price and the current market value. So if the strike price of the stock is $10 and the stock is at $50, then that's a $40 difference, and you're taxed at ordinary income, not capital gains tax, in which, again, those are big differences in the rates and how much you're going to owe in taxes. And so it's definitely important to know the difference and what's the impact when you are paying those taxes.
And people oftentimes get really confused when they bring their W-2s to me because they say, my W-2 is so big this year, I don't understand what happened. And so then typically the question is, okay, well, did you have a bonus? Were there stock options? Oh, yes, there were stock options. So let's just talk again. Catherine, you kind of presented a simple example, but let me talk a little bit more about what the difference in taxes could be. So let's just say you are granted these options, and typically there's a vesting schedule, so you have a time where you can exercise these. And so the question is when? When am I going to exercise them? So this is a really big decision because the taxes can make a huge difference. So let's just say under scenario one, your options, you're granted, let's just say 10,000 options. And your strike price is $10. So you've been offered the opportunity to buy these at $10. And you're watching the stock market go up, 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 and then it's at $30, and you're like, okay, well, I'm going to exercise now. So the difference between what you can buy them for, which is the 10, and the 30, which is the fair market value, in the tax world we call it the bargain element, or it's the spread, if you look in jargon. But it's really the difference between what you've been granted it for and what you can buy it for and what it's actually worth. What happens is that difference, that $20, gets added to your W-2. And that is a huge difference. If you wait longer, let's just say, again, under a second scenario, you've got 10,000 options. You can buy them for $10 a share. And now all of a sudden the stock is worth $60. So the difference between the two now is $50. So at $10,000, or 10,000 options at that difference between 10 and 60, that's $500,000. If you did it the lower dollar amount of $30 where the spread was only 20, that's $200,000. So that's a $300,000 difference. And as Catherine mentioned, this is taxed at whatever your ordinary income rate is. So that's whatever your tax bracket is.
And I guess one of the things that we hear sometimes is when you go to exercise and do this, potentially at that time, some people, they sell to cover the taxes. So they sell some shares.
Yep.
Some investors may pay cash to cover the taxes, and some may exercise, sell some, and then hold some of the shares. So there's a lot of different things. But I think one of the things we've had conversations in the past are that sometimes when they withhold the taxes for these shares, that
it's not enough.
Exactly.
Never enough.
So everyone's like, oh, I did it. I withheld taxes. And then the reality is there's surprises later because potentially there wasn't enough taxes withheld.
And then one of the things that you need to consider with this is really the timing, because timing is so key. And you have to consider all of your income for that year. And if you're married, you also need to consider your spouse's income, because typically what I see is people file jointly. So all of the income kind of gets stacked on top of each other. So let's just say maybe your spouse has a bonus, or maybe you sold a property. I mean, you really need to, or maybe the stock market's doing great that year, so you're going to have a lot of investment income that's getting reinvested. So you definitely want to be watching and making a determination of, when do I actually exercise, because it does make a difference, because that ordinary income does add up really quickly. And depending on the state you're in, you're also looking at state taxes. So for instance, in California, where you almost are at 10%, and California doesn't have a long-term capital gain, so you're going to be taxed at ordinary income. Yeah. So I'm going to kind of go back a little bit and kind of talk about an example, because there's a lot of different things and ways that these are taxed. So for instance, what we often see with executives, they get granted these options on top of these very large salaries. And if you are one of those people who has a very large salary, maybe your spouse has a very large salary, you very, very quickly can get kicked into the 37% bracket. And so there's also, when you exercise and pay tax on your stock options, you're not only paying federal tax and state tax, but you're paying Social Security and Medicare as well.
And then isn't there, also that net investment tax?
That doesn't apply to when you exercise, because
good.
it's taxed as ordinary income. And so, but that's a really good point, Catherine, because so let's just say you exercise and you don't sell right away, because like you said, there are a lot of different ways you can do. You can exercise and you can hold. And if you exercise and hold the stock for a year and a day, then later it's taxed as long-term capital gains.
The extra gain from that time you exercised.
Correct. Yeah. Yep. So let's just say it's granted at $10 a share. You exercise at $30, so that $20 per share is added to your W-2, and then you sell when it's $100 a share. So then the difference between the $20 and the $100 is $70. So that then later is taxed as long-term capital gain. And at that point, then it's subject to net investment income
I'll say
tax.
that tax comes up. I know it. I feel it. We see it. We hear about it.
So much. That's true. And so it really, I think all of this kind of boils down to a timing issue and what is your other income, so you can make an informed decision as to when do I sell, how much do I sell. And one of the things I really wanted to mention is when you exercise and the bargain element or that spread gets added to your W-2, when you get your W-2, take a look at it and compare it with your transaction records, because there will be a code V on your W-2 in box 12, and that will show you or tell you how much was taxed as ordinary income. Because what I've seen as a practitioner is when people get their 1099B forms, which is the reporting document when they actually go and sell, is that bargain element or that spread doesn't get added to the basis. And so
they're double taxation.
They're double taxed. Yes. So you want to make sure, especially if you're working with an advisor who hasn't been in the business for a long time or doesn't understand stock options very well, is make sure that they're aware. And I've said this before on podcasts, there's a supplemental tax document typically in the portal when you download your tax documents.
And it's hidden somewhere in there that nobody knows that until you mention it. They're like, oh, wait a minute, I'm going to go look for that.
You have to go find that.
Yeah, it's like a treasure hunt.
Yes.
And so we covered a lot of different kind of scenarios, and obviously there's some decisions to really think about. The real big decision is, when do I exercise? And there's kind of, we kind of alluded to, but there are definitely 4 key areas to consider. One is income timing. So is this a high income year for you, or is there an opportunity to exercise at a lower income year? So once again, coordinating your income benefits, potentially, is it, if you're married, you have a spouse or your own income. And then obviously another area to look at is kind of the stock outlook, and understanding the risk of waiting. I mean, there is, obviously we want things to go up in value, but things do fluctuate. So, considering that the stock outlook. And then also cash flow. Do you have the money to cover the taxes, or do you need to sell to cover? Do you want to exercise now and then you think potentially the stock will grow, so then you can hold the position and continue to grow it now at a long-term capital gain rate if you hold it for a year and a day? So there's a lot of different scenarios and things to consider. The other thing that comes up, or an idea to think about, is how much of your net worth is tied to this company's stock. So now, is this a concentrated position that you have? And so that's kind of where you want to make sure, are you diversified or with your overall strategy? And so it was interesting. We had a client that retired at the end of the year last year, and he ended up exercising some stock options, a substantial amount of money. And he decided to exercise and also take and sell the positions and take the money. And once again, there was a lot of tax consequences involved. But the thing for him was, he in the past had stock options and got burned because some of the stocks that he had before went down in value. And so he, at this point, is like, I just want to take it. I want the money, and they just phased into retirement. They now have enough money to retire and live, and so. Once again, yes, you look at the tax, you have to look at the stock, you have to look at the overall situation and see what's the impact for your particular plan and your situation. And so we know that, we want to be proactive and not reactive. And so having these conversations with us before you exercise is important. So we're happy to, have those conversations with you and kind of go over some different scenarios, because we want to make sure that, once again, you don't have a concentrated position. If we can minimize taxes, great. I mean, you're still going to owe taxes, but the reality is, if there's a way to time it,
I think there's definitely ways to do proper planning so that less of the money is taxed as ordinary income versus long-term capital gain.
Yes, and then sometimes I think what happens, we have some newer clients we worked with after they exercise, and then we're dealing with the aftermath of the taxes, and then also having a large tax bill later. So once again, the more proactive we can be and help with the planning, that's what we're here for. And so really having a strategy in place. And so some of the questions that kind of come up is, should you always exercise early? It depends. I mean, no, you should have a strategy and look at, not only the price of the stock and but the tax part of it. Then there's a question, should I wait till the end of the year? Yes, you should have a better idea of your income, but once again, you have to look at.
I had a client, this is so random, I know this is the end, but they decided to wait till the end of the year, and he had a big W-2 job, and so did he, but she wasn't working that year. So thought, this is a great year to exercise all the stock options. And then she got offered a job, and she got a $400,000 signing bonus.
No. Are you kidding me?
No.
Oh,
so
yeah. It doesn't.
Honestly,
sometimes it doesn't make sense to wait.
But now they said, what, we're just going to wait to actually sell to get the long-term capital gain treatment for those options.
And so the biggest mistake we see is treating this like a stock decision instead of a tax decision. And once again, we think of having a collaborative approach to this is important, and really knowing the difference and how this ties into your plan. So I know we covered a lot today on non-qualified stock options. Happy to be a resource and continue to educate you. So we want to offer, if you like a strategy session or a call with us, you can reach us at 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.